This is our Forex blog for January 3rd, 2012. And like we do most days, we want to buy the absolute strongest currencies and sell the weakest ones. To do that, we've come up with a currency meter that statistically compares each currency to every other one. The top histogram shows the real-time bar-by-bar strength or weakness. This is made up of 5 different statistical trend tools that we've developed over the last 6 years of doing Forex. 3 of them measure the percentages of the dollar going up or down. One of them measures the intermediate time frame statistical intensity, and the last one does a bar-by-bar intensity. We average those together in a very easy-to-read histogram. At and above the 80 dotted white line is extreme strength or weakness, and that is, tends to continue. As you can see, a weak dollar stays weak with, brief 40 minutes of strength here, but for the most part weak. Underneath that, we have the daily, weekly, monthly trend. I pretty much ignore the monthly trend, but I might occasionally trade larger lot sizes when the monthly trend matches the weekly trend. If the weekly trend matches the daily, the real-time trend here, then those trends are likely to continue. So the dollar's weak. You would want to trade that against one of the strongest ones. Now the euro had brief amounts of strength today, but the daily, weekly, monthly trend was down. The Australian is up on all time frames today, as is the New Zealand and the CAD to a much less extent. So, if you see a pattern of some strength coming in and then a little bit of weakness, most of the time, the strength will resume if the weekly trend is up in this case. And this one is very strongly up, as is the monthly trend as well. It always makes me feel more comfortable taking a trade when all the time frames are lined up. Now this one is not extremely strong until about 6 to 7, and then it has a little bit of weakness. Anytime you see extreme strength followed by very little weakness, that extreme strength is likely to continue, especially, like I said before, if the daily, weekly, monthly trend's up. And you can see after and usually the weakness lasts anywhere from about 30 minutes to 2 hours. After about 2 hours, if you have a big extreme move like this, it can have a pullback for 2 hours because it might be up too much. If it goes up for 6 to 10 hours at a time, it might pull back 2 hours before trying to go back up again. It doesn't mean the trend is going to keep going up, but it might go up enough to allow you to find a profitable trade, and that's all we care about. If you have a 10 or 20 or 30 pip win and you're losing 10 pips when you're wrong, 6 to 10 pips when you're wrong, and you have more wins than losses, or you have much bigger wins than losses, you should do well. So you want to buy the Australian dollar today, you want to buy the New Zealand dollar today. The yen was also weak, but the weekly, monthly trend was up, so you have better odds trading these strong currencies versus the dollar than the yen. The yen can resume its extremely strong weekly and monthly trend at any time. You never know when the weakness will stop, and you might have 10 hours of extreme strength. So your odds always go up. So let's look at the Australian dollar. Here it is, and you can see that this currency is above the hourly moving average. This is one of our filters. You can see the statistical trend tool on the chart itself. Extreme strength, very little weakness during the little pullbacks. It doesn't get any much more of a no-brainer than this, really. There's 2 methods that we use for entry. One is a half an hour to 2 hour sideways rectangle pattern, or a little wedge pattern like this. When it breaks out from under there, you go long. You put your stop underneath the bar's low, and you can use our statistical based trailing stops too if you want for your entries and exits when all the time frames line up. Some traders do that for simplicity reason. You buy here, out, small profit. Let's see where 85 to 90, not much of a profit. In here, very small win. Break even here, and then this last trade right here, 01 to 06, very small profit, and then in here at 18 and out at 60. So this last trade was 40 pips. And then the upper containment bands typically is when price kind of stalls and pulls back. It's risky to buy above the upper white band, and you always want to draw your fibs on the move too, from here to here. Typically you're going to get a 38 to 50% pullback before it goes up again. And I draw Fibonacci levels each night, and I plot them on your chart so you know exactly where they are, so you don't have to spend 30, 40 minutes a night doing it. And when the Fibonacci profit target level is above the upper containment band, it's moved statistically too far. This is a major level. There's likely to be some selling, and of course it is. So very high probability place to get out. You got a nice little decent 40 pip pullback right here. You're in, and anytime you buy a pullback, typically you want to put your stop underneath the bar's low. So you go in, the market kind of goes up a little bit and goes sideways. I wouldn't have got out of this trade here. And then as it goes up again, typically markets double top. Sometimes they go a little bit above there, but most of the time when the market's gone up so much on a relatively dead day, don't be greedy. When it's above the upper band for the second time, and you have a counter trend signal right here, you might want to look to get out. But there was one nice move here and another 40 pip move here, some small 6 to 10 pip wins and maybe a 2 or 3 pip loss. But the currency meter, really had you focus on a high odds trade. Let's look at the New Zealand dollar. Same exact thing. Now this one had a pattern last night that's very high probability, a narrow range pattern. Anytime, and these show up on a 4-hour bar, even though we have a 5-minute chart up, we have 4-hour data that's running in the background, and it's telling you that the previous 4 hours moved less than the previous 7 4-hour bars. So in other words, this tiny little 4-hour period right here moved less than during the previous 28 hours. Very low volatility, and breakouts of low volatility patterns tend to lead to trends, and you can see that it did. Not only do we have a narrow range pattern, but we had one right after it. This 4-hour period right here is even smaller than the previous 4-hour period. You can see that's the high of the 4-hour period, that's the low. This is the high of the previous 4-hour period and the low, and anytime you get 2 narrow range patterns in a row, it tends to lead to some nice trends. Most of the time, in my experience, in my opinion, you're going to get at least a 2-wave move up, which means if you buy the breakout right here, typically you can hold for at least 2 waves, which would be, up here at these profit targets, 78.41 would be a decent place. So that's about 50 pips away. And you can also trade these on each move. You buy here, you're out with a stop in here, small profit in here, maybe 20 pip profit in here, in at 28, out at 44, small 10 pip profit in here. You probably had a loss in here, a small win, and then this last trade. And again, the upper containment bands and my Fibonacci areas are likely to provide some resistance. It did here. It went to the second one, found resistance, and then this is the light gray ones are Fibonacci retracement levels, where the market went up and had major selling there. Now, sometimes currencies' weekly and monthly trends are down, but you have real-time strength, like in the pound. If you have a no-brainer trade like the Australian or the New Zealand, you might not even want to mess with the pound. But if the weekly trend and monthly trend are not that weak, or it is very much near the 100 level like this one is, and has extreme intensity, that intensity is likely to continue regardless of what the longer term trend is. But it may not continue more than another hour to 3 hours, and then you get some weakness coming back in. So you just never know. And that's why it's always best to stack the deck in your favor, in my opinion, by trading currencies where the statistics back up. The Australians and the New Zealand are stronger than pretty much all the rest of them. And the dollar is extremely weak. The euro is also weak with a weekly and monthly trend, but it also is showing signs of extreme strength. When you have extreme strength followed by very little amount of weakness, that strength typically does return, even if the weekly and monthly trend's down, but it doesn't return for as long. You might only have, like you can see here, an hour of strength. So at 9 o'clock, you certainly could, if you like to trade the euro because it has a smaller spread, let me get these things out of the way here, you certainly can trade it, but just be aware that it might not be as much of a move. And one of the things that we do for pullbacks, not only use the trailing stop for entries, draw your trend lines here, and when it breaks that trend line, you go long with your stop a pip or two underneath the low here. And this one only moved about 15 pips. It's at the first containment band at my Fibonacci profit target level. Pull back again and went up again. I prefer to use what I call range charts. Here's a range chart of this currency, and it tends to give you a little bit higher probability trades. You buy this pullback right here, and especially after 3 or 4 red bars, and it's pulled back 30 or 40 pips, and you have a support or resistance area. In this case, the 10-day moving averages right here. It broke from underneath above it. This is resistance. Once resistance gets broken, it tends to become support. Decent place to get in this trade right here at 20. Goes up to the next resistance here. You're at 45, it's 25 pips away. You probably want to exit half your trade there. And anytime I see a a couple bars going sideways like this, I tend to put my stop just a pip underneath it. There's no need to let your trailing stop that might be 5 pips farther away get hit. If this gets hit, typically your trailing stop gets hit, and you can, lock in a few more pips. So you add it of half of that at 38, and the other half at around 46. Your average exit would be around 42 or so for a decent, 20 plus pip win. If you risk 6 to 10 pips and you have, frequent 15 to 25 pip wins, that's the math behind successful trading.